Let's kick things off by exploring the core idea, market power. In simple terms, market power refers to a company's ability to influence the price or supply of a product in the market. Unlike in perfect competition where no single firm can sway prices, firms with market power can set prices above competitive levels. This concept is central to understanding how businesses operate and compete. Throughout this video, we'll break down the sources, effects, and real-world examples of market power, making it easy to grasp even if you're new to economics. To truly understand market power, we need to look at perfect competition. In this ideal scenario, many small firms sell identical products and no single company can affect the market price. Think of local farmers selling wheat, each one is too small to set their own price. This situation is rare in the real world, but it's a useful benchmark for comparing other market structures. When we see firms deviating from this model, that's where market power comes into play. Now let's look at the other extreme, monopoly. A monopoly exists when a single company dominates the entire market for a product or service. This firm has significant market power, allowing it to set prices without worrying about competitors. Classic examples include utility companies in some regions. Monopolies can lead to higher prices and less choice for consumers, which is why they're often regulated by government. Between perfect competition and monopoly lies oligopoly. In an oligopoly, a few large firms control most of the market. These companies often watch each other closely and may even coordinate prices or output. Think of the airline or smartphone industries where a handful of big players dominate. Oligopolies have considerable market power, but not as much as monopolies. Monopolistic competition is another common market structure. Here, many firms sell similar but not identical products. Each company has some market power because their product is slightly different. Think of coffee shops or clothing brands. They can set prices to some extent, but competition keeps them in check. This structure is common in everyday markets. So where does market power come from? There are several sources. First, control over key resources can give a firm an edge. Second, government regulations like patents or licenses can create barriers for competitors. Third, strong brand loyalty can make customers stick with one company. Finally, economies of scale allow big firms to operate more efficiently than smaller rivals. Barriers to entry are obstacles that make it hard for new companies to enter a market. These can include high startup costs, strict regulations, or strong customer loyalty to existing brands. When barriers are high, established firms can maintain their market power and keep competitors at bay. This is why some industries are dominated by just a few big players. One of the main advantages of market power is pricing power. Firms with market power can set prices above competitive levels, boosting their profits. However, this can also lead to higher prices for consumers. Pricing power is a key reason why regulators keep a close eye on dominant companies. Market share is a common way to measure market power. It refers to the percentage of total sales a company controls in a market. The higher the market share, the more influence a firm has over prices and supply. Companies often strive to increase their market share to gain more power and profitability. Market power doesn't just affect businesses, it impacts consumers too. When a company has significant market power, it can raise prices, reduce product choices, or lower quality. This is why competition is important. It keeps firms in check and ensures consumers get fair deals. To prevent companies from abusing market power, many countries have antitrust laws. These regulations are designed to promote competition and stop monopolies from forming. Antitrust authorities can break up companies, block mergers, or fine firms that engage in anti-competitive practices. Let's look at a real-world example: technology giants like Google, Apple, and Amazon. These companies have enormous market power in their respective fields. They can set prices, influence industry standards, and even shape consumer behavior. Their dominance has sparked debates about regulation and competition worldwide. Some monopolies occur naturally, especially in industries where it's most efficient for one company to serve the entire market. Utilities like water and electricity are classic examples. Building multiple competing infrastructures would be wasteful, so one firm provides the service, often under government regulation. Network effects occur when a product becomes more valuable as more people use it. Social media platforms and online marketplaces are great examples. The more users, the harder it is for new competitors to attract customers, giving established firms significant market power. Strong brand loyalty can give companies market power. When customers trust and prefer a brand, they're less likely to switch to competitors, even if prices rise. This loyalty allows firms to maintain higher prices and stable market positions. Product differentiation is another way firms gain market power. By offering unique features, designs, or services, companies can stand out from competitors. This uniqueness allows them to charge higher prices and build a loyal customer base. Economies of scale mean that larger firms can produce goods more efficiently and at lower costs than smaller ones. This cost advantage can help big companies dominate the market, making it tough for new entrants to compete. Some firms with market power practice price discrimination, charging different prices to different customers for the same product. Airlines are a classic example, offering various ticket prices based on demand, timing, and customer type. This strategy maximizes profits but can be controversial. Mergers and acquisitions can increase a company's market power by reducing competition. When two large firms combine, they often control a bigger share of the market, which can lead to higher prices and less choice for consumers. Regulators closely review these deals to protect competition. Sometimes, firms with market power may collude, secretly agreeing to fix prices or limit production. This is illegal in many countries and can harm consumers by keeping prices artificially high. Famous examples include international oil cartels. Large retailers like Walmart or Amazon often have significant market power. Their size allows them to negotiate lower prices from suppliers and offer lower prices to customers. However, this can also squeeze smaller competitors out of the market. In healthcare, market power can affect drug prices and access to services. Pharmaceutical companies with patents can set high prices, while large hospital networks may dominate local markets. This can lead to affordability and access issues for patients. Media companies with market power can shape public opinion and control access to information. When a few firms own most media outlets, they can influence news coverage and advertising rates, raising concerns about diversity and fairness. Big banks and financial institutions often have market power, allowing them to set fees and interest rates. Their influence can affect the entire economy, which is why financial markets are heavily regulated to ensure stability and fairness. Market power can drive innovation as firms with strong profits invest in research and development. However, too much power can also reduce the incentive to innovate if companies become complacent. Striking the right balance is key for a healthy economy. Governments use various tools to regulate market power, including antitrust laws, price controls, and public ownership of key industries. The goal is to protect consumers and ensure fair competition while still encouraging innovation and efficiency. Regulating market power isn't always easy. Rapid technological change, global markets, and complex business structures can make it hard for authorities to keep up. Regulators must balance protecting consumers with encouraging business growth. Globalization has changed how market power works. Companies can now operate across borders, making it harder for any one country to regulate them. This has led to calls for international cooperation to address issues like tax avoidance and anti-competitive behavior. Looking ahead, market power will continue to evolve as technology advances and markets change. New industries may emerge and existing ones may become more concentrated. Staying informed about these trends is important for both consumers and businesses. Wrap up, market power is a crucial concept in economics that affects businesses, consumers, and the entire economy. Understanding its sources, effects, and regulation helps us make sense of the modern marketplace. Whether you're a business owner, consumer, or policymaker, being aware of market power can help you navigate today's complex economic landscape.